Good morning and welcome to another What's Up with the Market status update. 28th of February, typically the last day of February, but we got one more day to go. But before we do that, I just need to cover a reminder before we get into the AFSL disclaimer. And the reminder is that none of this analysis is used in either of our mechanical trading systems, SPA3 Investor or SPA3 Trader, and that none of this analysis is used to make any of the decisions in the ASX and US public portfolios or the SPA3 Trader public portfolio. Those two, the SPA3 Investor portfolios are real money portfolios. The SPA3 Trader portfolio is not a real money portfolio. It is traded with live data, but not with real money. And I use none of this analysis that I'm going to do here today for my own personal portfolios. I'm a 100% mechanical trader, and I precisely follow the rules of our systems and have been doing for many, many, many years. I also have to tell you that everything we cover here today is of a general advice nature. There's no personal advice required that we provide here, and that it is general investment advice, and that you should seek professional advice from a licensed operator with an AFSL that has a license to do so. Okay, straight into the Dow Jones. I've got this zoomed out, going all the way back to the trough of COVID, which was back in March of 2020. So nearly a 4-year chart. And I've got on here, which I haven't shown before, a Fibonacci retracement going from that trough of the COVID trough to the highest peak that has been achieved in this sideways moving market prior to the top right-hand corner over here. And the reason I've done this is I want to see what the retracement is that occurred of the run-up coming out of COVID. Magic run-up retracement. So that retracement was just a slightly more than 38.2% retracement, which is normal for a bull market. So I'm painting a bigger picture here to start with, a little bit bigger than what I typically do in these sessions. And that retracement found support here, the double bottom, and has been rising to sideways ever since. So this is the Dow Jones. And then we had this little hiccup. I'll zoom in here, this little hiccup last year, which was a 38.2% retracement of that run-up from the trough of the previous 38.2% retracement, run-up, sideways breakout, didn't then make a new high. So that black sideways dashed rectangle is the all-time high back in December of 2021, and so is that green line. The green line is the high, and this 38.2, slightly more than a 38.2% retracement, a couple of bars that went below it, and then we've had this run-up, breakout to a new all-time high, pretty decent gradient in that run-up to breakout, a pretty strong test. What I mean by that is it didn't really, typically what you might see is it break right up and come down and test and then bounce, got through, bit of indecision and consolidation, sideways, another breakout, and then we've now got this rising market into new all-time territory above this dashed black rectangle here. So I've put a trend line in there since a trend channel since our last session. And we just want to see here now if there's any break below or breakout above the current gradient that we're moving in. So this is bullish. This is bullish. And now I'm going to say that there's a lot of material around the wall of worry. Bull markets always climb a wall of worry. And there are some people calling a top in this market. They're saying it's unsustainable. It's the same noise and analysis, even if you like. And people are now starting to look for confirmation to find reasons, if you like, technical and fundamental and all kinds, as to why this market should fall over and basically go into a long sideways moving market. Now, in the secular bull market update, I've given you the last two, and even in some of these sessions, I've given you examples of some really well-known, high-profile market commentators, Druckensmeyer and there's a whole bunch of others, Narelle Rabini, who is Dr. Doom, some others that are out there writing, and they've been predicting a long sideways stagnation in markets that are going to go for 10, to 13 to 15 years, a bit like Japan. We'll have a look at Japan in a moment. So there's a lot of predictions out there. Of course, there's doomsayers like Harry Dent and those have been saying 80% fall on the cards. But what we're seeing here is the evidence is that we have new all-time highs that are occurring, and and we're going to have a look at the Nasdaq Composite in a moment. But we still need a couple of indices to confirm this breakout. So not out of the woods yet, but it is breakout territory, new all-time high stuff. And it's really you have to really dig deep to go and find evidence to say you should be shorting a market like this, because all the evidence over 100 and something years is that you should get onto the back of this market. But there is a lot of noise coming out at the moment saying that we should be shorting this market and it's all going to collapse, because the reason Nvidia and a handful of stocks are what are pushing this market up. And also, which is true, the mid caps and the small caps haven't had a breakout yet, which we will keep an eye on. When they do, if they do, we'll report that in the session. So we have this wall of worry going on, and it will be a concern for some people. But we also know that when markets rise like this is the time that we've got to take advantage of them, and we've got to overcome the fears, the noise, and all the calls for the market collapsing in a heap, basically. So this is breakout territory, and I'm saying that, preempting the session today by warning you that you're going to see more and more wall of warriors out there looking for reasons as to why this market's going to fall. And listen, it may, but I'm not going to predict that. They are predicting it, and they're looking, scraping the barrel to find reasons as to why that's going to happen. What we've got to do is, as objective mechanical traders, even if you're not a mechanical trader, you're still got to be objective, is you've got to go to price action. And that's what we're going to do. We're going to look at price action. So let's go to the S&P 500. I'll zoom out here as well and go to the trough of the COVID-19 crash. And there was a run up. The green line over here shows, and it might be difficult to see that, but that's a 50% retracement. So the Dow had a 38% Fibonacci retracement, and the S&P 500 had a 50% retracement. So a bit more. So the wider market, so obviously there's more stocks as a broader index, had fell. That's telling you that some of the smaller cap stocks of the S&P 500 were the ones that fell. But we've still had the run up and a breakout to new all-time high that occurred there. It's within the channel, pretty steep run up, and has had a couple of retracements, just little, pretty short ones really, and then this big gap up last week, which is very bullish. You'd expect a little bit of retracement, and now this S&P 500 climbing the wall of worry. Sorry, turn the camera off somehow. Mouse flying all over the place. So some of these breadth of market indicators, none of them are showing any signs of worry. So confirming that this is a bull market, no divergence in the cumulative new high, new low. And there is also no, similarly with the, we're just getting a bit slow here, with the cumulative advanced decline line, also no evidence of any divergence there. So this is supporting the fact that we got a bull market. What am I looking at here? I'm looking at this gray line over here rising. That's showing that there are more stocks advancing than declining. And the breadth of market indicator, number of stocks in the S&P 500 above their 150-day simple moving average, is still positive up here in the 74th percentile. So that is, breadth of market is good in the S&P 500. The US dollar, key one to watch. A little bit of weakness creeping in on the right over here. We do have this, the green line over here shows this is risk on, meaning that the market is outperforming the US dollar. What we want to see is the market outperforming. So how am I seeing that? That's this relative strength line over here. The fact that it's declining is showing that stocks are outperforming the US dollar. When you get US dollar, like we saw over here, the blue line outperforming stocks, then we are, that's a signal that potentially we're going to get some weakness. That's not the case at the moment. And what we also want to see is not only outperformance of the US dollar in terms of relative terms, we also want to see the US dollar falling. So let's just have a look at the raw price action, and the US dollar has been right. I'm just going to this chart because it just shows more relative price movement. You can see that there's a little bit of weakness in the last 2 weeks, but was rising before that. So no early indications there that this market's going to topple. So no smart money going to US dollar and out of stocks. This one is the Russell growth v the Russell value. The relative strength line, the comparative relative strength is this over here showing that growth is outperforming value. And we've got this risk on over here, the CIROC smoothing of the relative strength line is showing that growth is outperforming value, and that is also a sentiment, market sentiment indicator saying that yes, we should be long stocks at the moment. This is the consumer discretionary Spider XL. So this is consumer discretionary XLY versus the consumer staple XLP. Relative strength XLY, just consumer discretionary outperforming staples. There's the risk on signal back over there. Even in this period of weakness over here, we still had discretionary outperforming staples as well. So this is at a bit of resistance over here, but certainly showing strength. So that sentiment indicator also positive for stocks. The number of puts versus number of calls that are being bought in the put call ratio on the S&P 500. We had a little bit of a red line over here that started rising, and now we've seen, which meant that puts were starting to outperform. The number of puts that were bought were outstripping calls that are being bought, but now we are seeing that is rising again, falling again. So more calls than puts, and that means it's risk on as well. So even that little hiccup, if you like, that we discussed a couple of weeks ago, that's now turned positive in favor of equities. The TNX, which is the 10-year Treasury note yield is rising, but so their yield was underperforming S&P 500, and now it's flattened out. So they're kind of rising at the same. What you want to see here for weakness is that the yield outperforms stocks, but it's not doing that. So there's the relative strength line between the two, and it's basically matching each other. But this falling CIROC here is because I've got the primary chart here as the yield, and the secondary chart as the S&P 500 is showing that it's risk on as well. So a smooth index. The next chart is looking at actual bond prices, not bond yields. This is the 20-year Treasury bond, and typically these move in unison, but we are seeing some divergence over here of bond prices falling, which means yields rising, and that is a bearish sign. You really want to see both stock and bond prices moving in the same direction, but there has been outperformance here of stocks over bond prices for quite some time. So not much on its own to worry about, but just one to keep an eye on. In terms of volatility, down at way down at low levels here at 13, really low levels would get down to, I think, around about 10. I've got that at. And so relative to past volatility on from the VIX, volatility is pretty low. Right, the Nasdaq Composite still has not made a new all-time high. Let's just go back to, as we've done with the other two major indices, the COVID-19 trough, which is back there in March of 2020, strong run up. And look here, that is a 61.8% retracement. So we had the Dow with a 38.2, the S&P 500 with a 50% retracement, and the Nasdaq Composite with a 61.8. So stronger run up and a deeper retracement. And that deeper retracement is probably the main reason that the Nasdaq Composite is struggling to get to a new all-time high. But it's pretty damn close, and it isn't an uptrend, and it is outperforming from this period over here. It is outperforming the S&P 500, so it's gradually catching up, but relative to itself, it hasn't yet made a new all-time high. We've had risk on since all the way back over here. There's the CIROC smoothing of the relative strength between the two, the ratio, and just to zoom in over here to see where it is relative to the new all-time high. So it's got to get above that green line over there. So it's pretty close, but not there yet. And we really do want to see a confirmation of the Nasdaq Composite getting above that breakout, that resistance, and to a new all-time high. Right, this is the Nasdaq 100, as I've been reporting in these sessions for quite some time now. Basically, since what date was that? Since mid-December is the breakout in the Nasdaq 100. So it's into new all-time high territory. That was the previous high back there, and there it is, new all-time high. So we've got of the Nasdaq 100's a new all-time high territory. Dow Jones and S&P 500, not the Nasdaq Composite yet, and it's risk on. No divergence here. We're starting to see the new high, new low, cumulative new high, new low starting to rise, which is also positive. And so no early signs there of new 52-week lows being made in the Nasdaq 100, and the same with the cumulative advanced decline rising as well. So there's no early warning signals or any divergence that's happening there, nor in the breadth of market indicator, pretty healthy. Not 100% of stocks are above their 150-day moving average, but there is 3/4 of them are on the Nasdaq 100. So no early warning signs there either. We've got the SOX, the Philadelphia semiconductor sector is also above its all-time high and rising. Of course, Nvidia is in this, and we're seeing other stocks now, QCOM and MU, Micron, are also giving buy signals on our mechanical system. So some laggards, if you like, relative to Nvidia, but this is rising. We've got the semiconductor index outperforming the Nasdaq Composite. We're measuring that against, so the broader Nasdaq market index is being beaten by the semiconductor index, and we certainly have risk on over here. Now, none of this should be predictive. What we're wanting to do is confirm by doing this generic technical analysis, sentiment and breadth of market analysis of the indices is to confirm and also to keep looking, or to confirm the bull market, if you like, the uptrend, but also to look for early warnings. And there were a couple of early warnings a couple of weeks ago, but not at the moment. So this is all risk on at the moment. Right, we have the All Ordinaries. Its all-time high is the green line up there. The all-time high close would be the top of the black, the top dotted black line over there, and it's pretty close. You can see there is the close there, not far off from its all-time high that was achieved back at the end of 2021. So that's another market we'd like to see make an new all-time high as well, but it hasn't. Now, Australian dollar is falling relative to the US dollar, and that's typically what you would see when the US dollar is a bit stronger. Right, the Nikkei. Let's talk about the Nikkei. That black line over there, although I haven't got all the data going back to 1989, I do have it, but I've got my limit set on 25 years here, is the all-time high achieved back in 1989 of the Nikkei. And it's now had three closes above its all-time high from all those years ago. So this is bullish as well. You can see the Nikkei, the Japanese market, is outperforming the S&P 500 as well. Let's go down now to the DAX. The DAX made a new all-time high in its session last night. And classic technical analysis, a few, 1, 2, 3, 4, fifth test to make a new all-time high, breaks through, a little bit of consolidation, comes back, tests the previous resistance zone, now support zone, support is found, and bang, off it shoots. Even though it is rising, even though it was rising in this period of time, notice here the relative strength line to the S&P 500 was that it was underperforming the S&P 500. This little tick at the bottom over here is showing a little bit of outperformance of the S&P 500. So that's the probably major European market that is and stock market, exchange, and it's a new all-time territory. The FTSE is not. There's its all-time high. It's even lagging more behind the All Ords, and also lagging the S&P 500, as we can see from the blue relative strength line here. China's had a bit of a kick, but it's had lots of little kicks on its way down. It's probably short term. That's the FTSE China 50 large cap stocks. This is the broader all share Shanghai index. Had a pretty steep bounce. Is it a V bottom? We'll see, but there's quite a lot of resistance over here. Major underperformance of the US markets for quite some time, for a number of years, going back 2000 and there we go, 5, 6, 7, 8 years more. So a long time China has been in the doldrums. Just to keep an eye on the Bovespa, as an indication of how developing markets are doing. A breakout to new all-time high, fallen back, still hasn't broken down below which this resistance zone, now support zone, hanging in there, and a positive day in its latest session, and this still it's in an uptrend, I would say, and we want to keep an eye on that to see how it goes to break out to a new all-time high. So just on that, on the equity markets, sure, a lot of people are predicting a fall, and some people are shorting the market. I would not be doing that. There's just not enough evidence to show weakness. You really want to do, as with, you don't want to pick tops and pick bottoms. You want to see evidence of a change in trend before you do it. So some people out there putting their reputations on the line. Let's see how they go. CRB index broken out of this down channel. So we're just going to go through the commodities. Broken out now, still in a downtrend, short-term downtrend. So commodities are a little bit weak at the moment, underperforming S&P 500. Gold still has tried another a couple, or we actually saw that price action last time we met. Didn't get through, come down, found support on the upper channel line here, and starting to rise again. Let's keep an eye on it. Obviously, it's close to all-time highs, as you know. So if we are bullish on gold here, and we put that hat on, we'd be going, okay, we're looking for a breakout, similar to what we are with the All Ordinaries or with the Nasdaq Composite. But it's just tried, so many times to get through to a new all-time high, and has struggled every time. Again, keep an eye on that, because that could be, one of the signs that we look for early warning on the secular bull market, which is this secular bear market, which would be a 10-year sideways moving market that so many high-profile people are predicting. Nothing to report on silver, a long way from its all-time highs. Copper broken out of this down trending channel over here, but hasn't broken above resistance, and is finding support, declining support, lower highs and lower lows. So that's not that bullish, but certainly not falling, but not rising either. Oil has broken out of its down channel, now got a gradient that's a bit less than the previous gradient that it had, that ran up to find resistance up here. And so a gradual rise in oil prices, but not that strong. Okay, Bitcoin. Wow, Bitcoin is certainly had a big run up. Two big green bars, or candles if you use candles. There was the sell signal. So this is just using a Ciroc 26.9 daily chart, which is a smooth index rate of change, a trending index, a trending it's a trending indicator, and that is on the raw price, not on the relative strength. But I do have a relative strength line here showing outperformance of stocks. So some pretty good trades that have occurred in the cryptos, and the two main ones being Bitcoin and Ethereum. So those of you that are in the short-term trade, if you do trade it, you'd be waiting for the Ciroc to cross down below in the green line, the moving average, to exit this shorter-term trade. Ethereum is the same. There was the entry signal around about 2,500. It's now at 3,200. This is a strong bull market. That's what these do, these cryptos. So certainly rising there as well. Uranium is the strongest of the commodities, getting to the top of this channel line again. A little bit of sideways movements and consolidation, but still off its all-time high that it achieved back in 2007, and is outperforming the URA ETF. So if you really want to trade, you get on the back of uranium, you've got to go and find uranium stocks. It's a better play than the ETF. And iron ore has fallen to the 125 mark, which is really a kind of an equilibrium price, and it needs to find support here to really continue the trend up. If that's going to be the case, we know China's back on board, buying a lot of Australian iron ore at the moment. Last one to look at, thermal coal. It's finding some support here between these two, the support and resistance zone, and does need to find support where it is at around about also 125, 120, 125 to really continue to find support, and then turn around and have it and change the trend to up. Right. Any questions? That is what I wanted to cover today. Theme is to really that it's risk on at the moment. We'll keep on looking for early signs of that potentially changing, but this is a market, and should have been for some time, a market that we should have had our money exposed to 100% a few months ago. Let me just turn on SPA3 Investor and see where that entry signal was on the S&P 500. It is way back here on the 10th of November, and you should have at the very least have got your exposure, lots of exposure to equities round about then. But those of you who are mechanical and trade the way that I do and the way that I do in the public portfolios, we obviously would have worn a bit of drawdown here, but would have been fully invested when that breakout occurred, and we have been ever since. Right, no questions coming in. I'd like to keep these to less than half an hour, which we've done. So thank you for your time and attendance. Theme is, it's still risk on. No evidence that we are going to see a collapse at this stage. In fact, there's evidence to the contrary that this trend is going to continue. And we got to look to see on the positive side, the Nasdaq breaking out to a new all-time high, the All Ordinaries breaking out to a new all-time high, and the other indices, major indices we've covered that are above their all-time highs to remain there and continue the trend up despite the wall of worry noise that's calling this for a long sideways movement and for the price action to move back into the trend, back into the range. That may still happen. I'm not predicting that it won't, but for the time being, we've got to trust that the market, we've got to trust the bull market and trust the price action and continue on the back of it. Right. Thank you. And some good things coming through. Pleasure, Rob and others. We'll end it there. Thank you for your time and attendance. And as always, I wish you consistent, objective, and peaceful active investing.